Hudbay Minerals has undergone a fundamental shift over the 2024-2025 period, characterized by a transition from a high-leverage producer with operational concentration to a diversified, multi-asset copper-gold enterprise with a robust balance sheet. The company's intrinsic value is anchored by its three long-life operating hubs in Canada and Peru, complemented by a growth pipeline in the United States, most notably the Copper World project in Arizona. Asset portfolio: the Peru business unit, Constancia and Pampacancha. The Constancia operation, located in Cusco, Peru, remains the company's most significant copper asset. Its value proposition is centered on its longevity and the recent addition of higher-grade satellite feed.
The mine life was extended to 2041 in early 2024, following the conversion of mineral resources to reserves in the 10th mining phase of the Constancia pit. This extension was supported by positive geotechnical drilling and studies that optimized the pit shell design. The operational profile of Peru is currently in a transitional phase. Through 2024 and 2025, production has benefited from the high-grade Pampacancha pit, which provides a significant boost to copper and gold output. However, the depletion of Pampacancha, expected in late 2025, necessitates a shift toward the lower-grade ore of the main Constancia pit. To preserve margins during this transition, Hudbay is executing a mill optimization plan that includes converting the third ball mill into a second SAG mill, a project that remained on schedule for ramp-up in the fourth quarter of 2025. This enhancement is designed to increase throughput and offset the grade decline.
The operational resilience of the Peru unit was tested in late 2025 by social unrest and blockades that forced a temporary shutdown of the Constancia mill on September 22. The suspension lasted approximately 2 weeks. While the mill returned to full production by early October, the disruption caused the deferral of a 20,000 dry metric ton copper concentrate shipment, valued at approximately $60 million, into the fourth quarter. Manitoba Business Unit, Snow Lake and Lalor. The Snow Lake operations have transitioned from a copper-zinc-focused producer into a high-margin gold producer, largely due to the integration of the new Britannia gold mill and the Lalor mine. In the third quarter of 2025, gold production accounted for more than 38% of total corporate revenue. The Manitoba hub has a mine life extending to 2037, with an annual gold production target exceeding 190,000 ounces over the 2025-2027 period. The company's Snow Lake gold strategy involves utilizing the new Britannia mill for high-grade gold-copper ore from Lalor, while using the Stall mill for base metal-rich feed. The value of this hub is expected to be further augmented by the 1901 deposit, where development is underway to provide additional ore feed. Current gold reserves at the site are estimated at approximately 1.7 million ounces.
In 2025, Manitoba production was severely impacted by mandatory wildfire evacuations that persisted for a majority of the third quarter. Despite this, the site maintained strong operational cost control, and the company's improved consolidated cost guidance reflects the outperformance of Manitoba's gold grades and byproduct credits. The full repayment of the gold prepayment liability in August 2024 was a major de-risking milestone, allowing the company to realize the full upside of spot gold prices. British Columbia Business Unit, Copper Mountain Consolidation. A significant enhancement to Hudbay in 2025 was the consolidation of 100% ownership in the Copper Mountain mine. Previously a 75-25 joint venture, Hudbay acquired the remaining 25% interest from Mitsubishi Materials Corporation, MMC, in a transaction that was immediately accretive to net asset value per share. This consolidation simplifies the corporate structure and increases Hudbay's exposure to a long-life copper asset in a Tier 1 jurisdiction. The mine life is maintained until 2043, and the company is executing a 3-year optimization plan to increase mill throughput to 45,000 tons per day.
The integration of the new Ingerbelle project is essential to the long-term viability of the BC hub. New Ingerbelle is a 3-phase pushback of the historical Ingerbelle pit that will extend the life of mine from 2033 to 2040. Regulatory progress in 2025, including the advancement through the BC Major Mines Office Coordinated Authorizations process, indicates that construction of the necessary bridge and haul roads will occur between 2025 and 2027. While BC's copper production in late 2025 was trending below the low end of guidance due to the processing of low-grade stockpiles, the site is on track to achieve $20 million in annual operating efficiency gains. Strategic growth and project monetization. The company's growth profile is centered on its pipeline of United States assets, specifically the Copper World Complex in Arizona and the Mason Project in Nevada. These assets represent the next leg of the intrinsic value proposition. Copper World, the Mitsubishi Partnership. The most significant strategic development of 2025 was the announcement of a $600 million joint venture agreement with Mitsubishi Corporation for a 30% interest in the Copper World project. This transaction fulfills a core component of Hudbay's 3P strategy: permitted, prudent financing, and in place.
The partnership significantly de-risks the capital requirements for Phase 1 of the project, which is fully permitted following the receipt of the air quality permit in early 2025. Phase 1 of Copper World is characterized by the following parameters: ownership structure, 70% Hudbay and 30% Mitsubishi. Annual copper production, 85,000 tons on average, with a peak of 100,000 tons. Mine life, 20 years for the first phase. Economic impact, a post-tax NPV of $1.1 billion and an unlevered IRR of 19%. The Mitsubishi investment includes an initial $420 million payment at closing and $180 million contribution within 18 months, which will be allocated toward development costs. This structure reduces Hudbay's remaining equity requirement to approximately $200 million and increases the project's levered internal rate of return, or IRR, to roughly 90%.
Sensitivity analysis of the Copper World project reveals that it is most sensitive to fluctuations in revenue, price and volume, and operating expenses, with capital expenditure being a secondary risk factor. A 6% change in revenue alters the IRR by as much as 14.8%, whereas a 6% change in investment only shifts the IRR by 2.88% to 6.93%. This highlights that the project's value is more dependent on the realized copper price and operational efficiency than on initial construction costs. Mason and other projects. Beyond Copper World, the Mason project in Nevada provides long-term optionality. It is one of North America's largest undeveloped copper deposits, with a pre-feasibility study (PFS) mine life of 27 years and average annual production of 140,000 tons during the first 10 years. While Mason is currently in the pre-development phase, its scale ensures that Hudbay has a pipeline to sustain production levels into the 2040s and beyond.
Financial strength and capital structure. The intrinsic value of Hudbay is also reflected in its transformed balance sheet. After years of high debt following the construction of Constancia and the acquisition of Copper Mountain Mining Corp., the company has successfully reached its leverage targets. Deleveraging and liquidity. As of September 30, 2025, the company reported a robust financial position characterized by the following metrics: cash and cash equivalents, $611.1 million. Total principal debt, $1.05 billion. Net debt, $435.9 million. Total liquidity, $1.04 billion. Net debt/adjusted EBITDA, 0.5x. The company has aggressively pursued debt retirement through the repurchase of senior unsecured notes. In 2024 and 2025, Hudbay repurchased and retired hundreds of millions of dollars in debt, often at a discount to par, reducing the total principal debt to $1.05 billion by September 2025. The pro forma cash position following the Mitsubishi JV transaction is expected to exceed $1 billion, effectively neutralizing the company's net debt. This financial flexibility allows the company to fund its growth projects organically or through existing committed facilities, significantly reducing the risk of shareholder dilution.
Cost performance and byproduct credits. For 2025, the company improved its consolidated cash cost guidance multiple times,
ultimately lowering the range to $0.15 to $0.35 per pound of copper produced from an original range of $0.80 to $1 per pound. Similarly, the sustaining cash cost guidance was improved from an original range of $2.25 to $2.65 per pound to a new range of $1.85 to $2.25 per pound. This industry-leading cost position is driven by high gold byproduct credits from Snow Lake and Pampacancha, as well as disciplined operating cost control across all sites. Relative valuation and peer comparison. Assessing Hudbay's stock requires a comparison of its trading multiples and asset-based valuation against its peers in the copper mining sector. Key peers include mid-tier producers like London Mining, Capstone Copper, and Arrow Copper. Multiples-based valuation. Historically, Hudbay has traded at a discount to its peers due to its perceived higher leverage and the geopolitical risk associated with its Peruvian assets. However, as of late 2025 and early 2026, many of these concerns have been mitigated.
Based on early 2026 data, the valuation multiples comparison is as follows. Hudbay, PE of 17.3x, EV/EBITDA LTM of 6.7x to 11.0x, PS of 3.94x, and PB of 2.58x to 3.09x. London, PE of 81.4x, EV/EBITDA LTM of 10.3x to 11.8x, PS of 4.60x, and PB of 4.60x. Capstone, PE of 23.3x, EV/EBITDA LTM of 10.5x to 19.2x, PS of 3.40x, and PB of 2.20x. Arrow Copper, PE of 21.8x, EV/EBITDA LTM of 11.4x, PS of 5.12x, and PB of 4.57x. Hudbay's PE ratio of 17.3x is significantly lower than the industry median of 25.5x, suggesting that the market is not yet fully pricing in the company's improved margin profile or its growth pipeline. The EV/EBITDA multiple is also near the low end of the peer range, particularly when compared to Capstone and London, both of which have seen multiple expansions following successful development milestones. Net asset value and SOTP analysis. A sum of the parts analysis, or net asset value analysis, provides a more granular look at Hudbay's intrinsic value. Analysts estimated the company's net asset value per share and AVPS at approximately $15.51 as of late 2025, which reflects a 5% increase over prior estimates. The stock currently trades at a price to NAV, or P to NAV ratio, that fluctuates between 1.0x and 1.3x. A bear case forecast suggests a potential trade down to 1.0x NAV, while the bull case notes that strategic investments like the Mitsubishi JV imply a significant premium to consensus NAV for the underlying projects. The intrinsic value gap is particularly evident in the Copper World valuation. The $600 million for a 30% interest implies a total project valuation of $2 billion for Copper World alone, which is nearly 25% of Hudbay's total market capitalization, despite the project being only one part of the company's diversified portfolio. Competitive positioning. Hudbay distinguishes itself from peers through its unique commodity mix. While peers like Tazeco and Capstone are more concentrated in copper, Hudbay's 38% revenue exposure to gold provides a defensive buffer during periods of copper price volatility. Furthermore, the company's leverage ratio of 0.4x to 0.5x is among the lowest in its peer group, providing balance sheet resilience compared to more heavily indebted peers. Hudbay Minerals net debt per EBITDA of 0.5x, net margin of 22.38%, and ROE of 8.89%. Teck Resources net margin of 9.41% and ROE of 5.03%. EO Copper net margin of 23.44% and ROE of 17.07%. Century Aluminum
net margin of 3.47%, and ROE of 12.83%.
Institutional ownership. Institutional sentiment has strengthened significantly, with 57.82% to 64.86% of the company owned by large asset managers and hedge funds. Notable recent stakes have been taken by GMT Capital, Hancock Prospecting, and Norges Bank, indicating that investors are recognizing the company's valuation gap and growth potential. Risk and sensitivity analysis. Despite the robust intrinsic value, several company-specific risks could impact the investment thesis. Operational and social risks. The most pressing risk is the social environment in Peru. While Hudbay has a long history of successful community engagement at Constancia, the region is prone to protests and blockades that can disrupt production. These disruptions, even when temporary, create volatility in quarterly earnings and can affect investor sentiment. Grade and throughput risks. The transition to lower-grade ore at Constancia and the reliance on mill throughput optimizations, the SAG mill project, present technical risks. If the mill enhancements do not achieve the expected recovery rates, unit costs could rise higher than the current sustaining cost guidance of $1.85 to $2.25 per pound.
Project execution and permitting. While Copper World Phase 1 is fully permitted, Phase 2 requires federal permits, which may be more difficult to obtain. Furthermore, the timing of the final investment decision, or FID, in 2026 is a critical milestone. Any delays in the definitive feasibility study, or DFS, could push the production start date beyond the current 2029 estimate. Conclusion. Hudbay Minerals Inc. represents an investment case based on a disconnect between its intrinsic asset value and its current market valuation. The transformation of the capital structure, moving from a position of net debt to pro forma net cash, has removed the primary hurdle to valuation re-rating. The strategic alliance with Mitsubishi for Copper World not only validates the quality of Hudbay's development assets, but also provides a non-dilutive path to a 50% increase in consolidated copper production. On a relative basis, the company trades at a discount to peers like London and Capstone. As Hudbay moves toward the sanctioning of Copper World in 2026 and demonstrates steady-state performance from its Canadian mill optimizations, the gap between price and net asset value might narrow. Going forward, investors should focus on the quarterly execution of mill throughput targets and the progression of the Copper World DFS as the primary catalysts for the next phase of value realization.